Here is a number that should really bother you. $34 trillion. That number is already wrong, because by the time you finish watching the video, it is out of date. According to official data on the official website of the U.S. Treasury Department, U.S. Treasury bonds have exceeded $36 trillion, climbing about $1 trillion every 100 days. Most people, even financially savvy people, see this as a political debate, with Democrats blaming Republicans and Republicans blaming Democrats, and nothing will change. But this is not a budget dispute. It is a structural problem that has the real potential to destroy your retirement accounts, mortgage rates, savings, and, frankly, the entire global financial system as we know it. The reason most people don't respond is actually the most troubling part of the story. Start with scale, because humans are really not good at processing huge amounts of data. 1 million seconds for about 11 days. 1 billion seconds to 31 years. About 3,700 years ago, a trillion seconds landed somewhere, and now times 36. But the raw debt data is actually the least worrisome part of the equation, because Wall Street analysts actually track debt to GDP, a measure of debt to the size of the entire U.S. economy. It peaked at about 106% during World War II, when everyone considered it a real emergency, until decades of post-war growth slowly restored it. The Congressional Budget Office, a nonpartisan government agency rather than a fringe think tank, currently has a policy of about 123% and is expected to reach 166% by 2054. The trend worsens every year, even if Congress does nothing. Now, there is a serious setback: Japan. S debt to GDP ratio is more than 250%, and Japan has not yet collapsed. So why is all this important? Japan's comparison is one of the most widely misused arguments in the financial media, and we'll break it down appropriately later in this video. Because the situation in Japan and the United States is so different that most people who hide them ignore the whole point. When people actually look at the numbers and tabulate them, they are often shocked to find that the federal government spends about $6.8 trillion a year and earns about $4.9 trillion in tax revenue, while the gap of about $1.8 trillion to $2 trillion a year is invariably added to the national debt. Social Security and Medicare together consume more than 40% of federal spending, and with 10,000 baby boomers retiring every day, these costs have no natural mechanism for decline. They are structurally locked in and growing. Defense spending is about $850 billion a year, the largest military budget in raw dollar terms in American history, but a program barely mentioned in casual conversations is becoming the most explosive figure in the entire federal budget. Net interest payments on debt. In fiscal year 2024, the United States spent only more than $1.1 trillion on interest, did not reduce the principal, did not fund any projects, and only to maintain financial lighting, which exceeded the entire defense budget. Here is what happens to interest payments. They fuel what economists call the apocalyptic cycle, in which higher debt requires more borrowing. More borrowing drives higher interest costs. Higher interest costs widen deficits, and larger deficits require more borrowing. The Congressional Budget Office predicts that if interest rates remain high, the cost of interest rates could reach $1.7 trillion a year by the end of the century, which means that we are watching the formation of financial black holes in real time with the naked eye, and many of us are looking elsewhere. For about 15 years from the 2008 financial crisis to 2022, the U.S. government borrowed at near zero interest rates. The Federal Reserve kept interest rates at a minimum, and Treasury yields at a micro level. In this environment, debt accumulation is barely included in interest costs, equivalent to 0.1% of credit card balances, and is growing, but the minimum payment is still controllable. Then, in 2022, the Federal Reserve launched its most aggressive interest rate hike in 40 years, all the way from essentially 0 to 5.25% to 5.5%, to combat the worst surge in inflation since the early 1980s. House prices have been falling since then. But what people miss is that when the hike stops, the problem is not solved. Instead of borrowing at a single 30-year fixed rate, as homeowners do, the federal government borrows over a range of maturities. Some in weeks or months, some in 2-year notes, some in 10-year bonds, and some in 30-year bonds. When short-term debt matures, the government must extend the maturity of the debt by issuing new debt to replace the old debt, which will be priced at current market interest rates, rather than the old low interest rates since 2020. Between 2024 and 2025, about $9 trillion and $10 trillion of U.S. debt needs to be refinanced, and the cost of refinancing is significantly higher than the debt it replaces at current interest rates. Even if the Fed cuts interest rates to 3.5%, it is still well above zero, and the United States faces trillions of dollars in increased interest costs, which are now included in the arithmetic and cannot be reversed. This is not theoretical modeling. This is accounting. The United States government finances its debt by selling Treasury bonds, which for decades have been hailed as the safest single investment on Earth, and a place for global money to flee when things go wrong anywhere. In the context of the financial crisis, geopolitical shocks, the epidemic, the influx of funds into U.S. Treasury bonds, the strengthening dollar, and falling yields, the United States continues to benefit from what economists call a safe haven status. This dynamic remains largely unchanged, but cracks are forming. Fitch Ratings stripped the AAA credit rating of the United States in early 2023 and downgraded it to AA+, followed by Moody's negative outlook for US debt, which was finally fully downgraded in 2025, becoming the last of the 3 major agencies to cancel the highest rating in the United States. Credit rating changes alone will not set off the market, but they represent institutions that assess credit throughout their business, which have written that confidence in fiscal management in the United States has declined. Bond markets responded in their own way. As the most important single interest rate in the global financial system, the 10-year Treasury yield reached 5% for the first time at the end of 2023, which is important because the 10-year Treasury yield is the benchmark for setting mortgage interest rates, corporate borrowing costs, auto loan interest rates, and student loan interest rates across the economy. Traders use the term bond activist to describe what happens when investors lose confidence in the government's fiscal discipline, stop buying bonds, or demand higher yields to compensate for risks, forcing the government to make ugly choices between raising taxes, cutting spending, or facing a real financing crisis. In September 2022, the Leeds Truss government announced no money to cut taxes. The pound plunged. Treasury yields soared, the Bank of England had to intervene to prevent a pension fund collapse, and Truss resigned within 45 days. The United States is much larger. The dollar holds reserve currency status, and the United States is not Britain. But the basic principle is not that it is small or big. Market price risks will eventually emerge, whether politicians admit it or not. The retort is always this: Japan's debt as a share of GDP has been above 250% for years, and Japan has not yet collapsed, so debt is clearly irrelevant to the way pessimists claim. Serious economists have made this argument, and it deserves a serious answer, not a rejection, because of Japan's unique structural conditions. Japan maintains extraordinary debt levels, starting with about 90% of Japanese government bonds held by Japanese institutions, such as the Bank of Japan, Japan pension funds, Japan insurance companies, and Japanese households. Japan basically owes itself money. No currency mismatch. No panic among foreign creditors. No dollar risk embedded in the equation. The Bank of Japan also effectively acts as the last buyer of its government bonds. By maintaining interest rates at or near zero for 30 years, through a policy called yield curve control, which means that when you set interest rates at zero and control the bond market, the huge debt burden is mathematically controllable. Almost none in the United States. The creditor base of American debt is much larger globally, including trillions of dollars held by private investors in China, Japan, Britain, and around the world who are not particularly loyal to American fiscal results. When foreign demand for treasuries wanes, yields must rise to attract new buyers. Nor can the United States keep interest rates at zero indefinitely, because doing so in 2020 and 2021 will create inflationary conditions that will force a generation to go through the most aggressive interest rate hike cycle, and the dollar's role as the global reserve currency, America's biggest financial advantage, means the world is watching at a level of scrutiny that Japan has never faced. The loss of confidence in U.S. Treasury bonds has not only hurt the United States, but also greatly destabilized global trade, commodity pricing, and international capital flows, making Japan completely unmatched by the United States. Japan's sovereign debt crisis is a serious economic event. The real dislocation of the U.S. Treasury bond market will be closer to the reorganization of the global financial order. Economists typically list 3 paths out of sovereign debt situations of this size, but none are painless. The way out for growth is optimistic. When the economy grows faster than debt, the ratio of debt to GDP stabilizes or falls, as happened after World War II, when strong post-war productivity growth, coupled with a surge in population and global export dominance, enabled the United States to reduce its debt burden without significant austerity. The question is whether anything replicates that today. With the Congressional Budget Office's baseline forecast incorporating moderate growth assumptions and the debt trajectory deteriorating, meaning it will need an economic outcome that far exceeds anyone's current forecast of $36 trillion in compound growth at current rates. The second path is austerity and reform, with Congress taking fiscal consolidation seriously through spending cuts, tax increases, or both. The political difficulties here are almost impossible to overstate, because every dollar of spending cuts has supporters, and every dollar of tax increases has a lobbying body against it. Budget analysts believe that under current conditions, the fiscal adjustment needed to stabilize the ratio of debt to GDP is about 5–6% of GDP annually, which is unprecedented in peacetime American history. The third path is inflation and financial restraint, which is the political direction with the least resistance. Historically, governments unable to grow or reduce debt have weathered debt crises through inflation, not hyperinflation, but through sustained medium and high inflation that gradually erodes the real value of outstanding debt. With financial repression, interest rates remain artificially high, effectively transferring wealth from savers to the government. Because your savings account income is 2%, inflation is 4%, and the real value of your savings quietly declines. Year after year, the real value of government fixed-rate debt has fallen. The government has taken the lead, and depositors have borne the losses. If your purchasing power feels like it is eroding, you've experienced a mild version of this dynamic. Even if nominal interest rates seem reasonable, and serious economists believe that based on this logic, we may be entering a period of decades before the actual part. One thing needs to be clarified. This is not a call for panic, nor is it a reason to buy gold and build bunkers. The U.S. economy will not collapse tomorrow. It may not collapse next year, and it may not collapse in any sudden and dramatic way in the next decade. But the risk profile of assets traditionally considered safe has changed, considered before the crisis, not during it. Inflation-protected assets have received serious attention in this environment, including Treasury inflation-protected securities. Tips: a government bond designed to work against you when inflation rather than rising prices. Broadly speaking, real estate assets, including real estate, commodities, and infrastructure, hold value in ways that nominal bonds do not have during periods of inflation. The stock exposure of companies with actual pricing power is also better suited to this environment than that of most companies. This category includes energy companies, major consumer goods with strong brand loyalty, and industrial goods related to real-world supply chains, which tend to outperform interest rate-sensitive growth stocks when fiscal conditions deteriorate. When you realize that every dollar you hold has the same exposure to the base currency, international diversification can be used as a partial hedge against dollar weakness, not a bet on the United States, but basic risk management. In terms of fixed income, short-term bonds reduce market value risk in an environment where long-term yields face sustained upward pressure from fiscal concerns. The most expensive mistake that ordinary Americans now make is to see it as background noise, which appears in the news cycle, but does not touch their actual financial lives. America's fiscal trajectory affects interest rates, inflation, and the value of every dollar in your savings account. Active participation is no longer optional through your own research, or qualified financial advisors, or both. Here is the bottom line for all this honesty. The United States has experienced this before. Fiscal tension, political dysfunction, global skepticism about its fiscal management, and every time the conventional wisdom says the problem can't be solved, somehow it passes. But muddling along comes at a price. Each year of deferred liquidation is another year of compound interest, another year of interest payments, crowding out real investment, another year of structural risk exposure to shocks, and ultimately forcing an ugly solution to emerge with no choice. Debt has not gone away. The question is only who will ultimately pay higher taxes. Reduced benefits. Inflation eroding savings, or some combination of the three. Because there is no clean exit at the end of the road. Those who understood this early and positioned themselves accordingly were those who came out of the other side with something intact. This is the channel's theme. Not panic or politics, but numbers, logic, and honest conversations about where they go. If this is useful, click the like button because it tells the algorithm that a real financial analysis is worth developing. If you're new, sign up because we go deep every week. And in a comment, you read in good faith, do you think the United States can really solve the problem? Or close the window. I read every comment. See you next time.